Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
John, how are you doing?
I'm doing fantastically, but not as always. Today we also have friend Ryan Bernal. Ryan, say hello.
Hey everyone, how you doing?
All right. If you're not familiar with Ryan, he is another member of our investment committee, and today, here we are at the end of 2024, which has been yet another confusing year. I thought what we do today, guys, you all thought it'd be a good idea as well. Just go through some of our predictions for the upcoming year, and you'll see these predictions in our upcoming quarterly analysis piece called Macro and Market, which should be available for general consumption and distribution by the third or fourth week in January. So this is sort of a free preview. How about that? Well, it really doesn't matter because Macro Market's free as well, isn't it?
It is free.
All right. So there you have it. So predictions for first quarter 2025 and beyond. And guys, this is the first prediction we're going to make. I think it's maybe the safest one. That's why it's number one on the books. It'd be interesting to see what your thoughts mean. We don't have to talk long for each one, but just what do y'all think? After a couple of consecutive years of outsized returns, it remains to be seen what U.S. stocks can do for an encore in 2025. The easy money bet would be for increased volatility and lower returns in the upcoming year. However, you could have said that about 2024 as well. I wrote it, so I'm pretty good with it, guys. What do you think?
Well, it's kind of one of those things. At some point, what you're paying for stocks matters. And that's something we've seen stocks become more expensive. We've seen a lack of volatility. So I think that's partially just kind of the easy bet of things normalizing a little. Stocks maybe getting back to their normal multiples at some point and maybe a little bit of volatility returning.
All right. I mean, Ron tells Sammy's wrong.
Yeah, I mean, just as a counterpoint, I mean, we talked a little bit about the end or about 2024 at the end of 2023, and we were a little bit more bearish, I think, than most of us thought going into 2024. So obviously there were some signs of a weakening economy, but 2024 did not seem to get the message.
Well, there you go. Pretty good answer. All right, here's the second prediction for 2025. There is nothing currently in the crystal ball to suggest international investments will significantly outperform U.S. domestic ones. There isn't a legitimate threat to the dollar's hegemony, and the U.S. economy is poised to outperform the remainder of the G7 for the foreseeable future. Now, when I wrote that, I actually did some math, went to some IMF predictions, OECD, and yeah, sure enough, it's not just us saying the U.S. is poised to outperform the remainder of sort of the so-called Western world or developed economies. Other people were saying it too, and so pretty much not just other people. Pretty much all other people were saying the same thing, and I think it's very fair. The dollar's strength and just hegemony over other major trading currencies is pretty much without par. So, you guys tell me: is there anything in the crystal ball to suggest international investments are going to significantly outperform U.S. ones?
Not really. And the other thing is when we're talking about whether to invest in international markets and we're talking about currencies, this is all a relative game.
Yeah.
And so what we've seen is we're in a not great spot maybe by some estimations, but we are in a much better spot in terms of economic growth, inflation coming back down than pretty much the rest of the developed world and the emerging markets.
Yeah, I agree.
Yeah, I mean, John, you've said it a few times, and I'll reiterate it here, but it doesn't seem like any of the other major Western European countries, their leadership really has anything going for them. I think we've talked a little bit about the Brits over there and just kind of their mismanagement of their economy, and it just seems to be the same.
Well, there you go. I'm glad I'm teaching you xenophobia and nationalism amongst other things that right. All right, here's the third prediction for next year. Any hiccup in the U.S. equity market during the first half of 2025 will feel like the flu in the crypto markets. This is getting to be a pretty predictable pattern, rally like crazy, completely fall apart, and then languish for an extended period of time. Repeat. Basically, expect sanity to return this asset class in the first quarter. I feel pretty strongly about this one. I mean, what I've meant to say in this prediction is, hey, we've been this before. Mm-hmm. Rallies like crazy, and just when you get that FOMO, fear of missing out trade, once it's really at its zenith, people who are in first go, I'm done for now. Take their money out, and you have mom and pop and all those others sitting there holding the bag. As I said, when my 88-year-old dad starts asking me about crypto, all the money's in.
Time to sell.
Well,
we've seen it before, and the chart that shows the top asset classes and worst asset classes. each year, and Bitcoin is either at the very top or at the very bottom, and we've seen it at the very top. And so, whether it's at the very bottom, this kind of contraction, we've seen it when markets start to get more volatile, that is an area that feels it a lot more.
Ryan, you're the youngest guy here by a couple years, and you should be just by that measure alone, you should be a crypto fanatic. Tell me why this is wrong.
Actually, quite the contrary there, John. I'm actually pretty skeptical about cryptocurrency in general. I think you're right. A lot of people my age do talk about crypto, and I think a lot of them think of it as a get-rich-quick kind of thing. But other than that, just the core technology itself, I get how the blockchain can be useful for certain things, but at the end of the day, it's a currency, and if nobody uses it as a currency, then it doesn't function as its actual purpose. So I'm pretty skeptical on it. Obviously don't hold much of that here, and so continuing.
I think we could perhaps agree to disagree, or perhaps I could twist your arm eventually to say cryptocurrencies are an actual currency. Sam, your thoughts on that?
I agree with that.
Well, there you go. And I think Ryan ultimately will come around to seeing that. All right, the fourth prediction here is the Bureau of Labor Statistics, BLS, and the Bureau of Economic Analysis, BEA, will make negative revisions to their employment and gross domestic product data. Neither will end up being as strong as originally announced, and a lot of people will call it some kind of conspiracy. All right, I'm borderline sound like a conspiracy nut here myself. If you've read Common Sense over the last, really, our newsletter over the last couple months, you probably know on at least 2 occasions, maybe even more than that, I have called out the BLS for having such wide disparities in their labor gauges. The household data is saying one thing, the establishment data is saying something else, and it's going to be one of those ones where I don't see how the BLS can do anything but have some pretty major revisions. Taking a look at the BEA's calculations of the gross domestic product equation, I think we're going to see some revisions there. I will tell you this, I think the revisions to the labor market data during the first maybe 2 quarters of next year are going to be much sharper than what it is for GDP. Sam, tell me I'm wrong.
You're not wrong, and we've talked about it in the sense that calling landlines and knocking on doors is not a great way to extrapolate out what's happening in the U.S. economy. And so that alone is going to cause errors in the data that they're collecting. So to get revisions from that, we start to get state data that comes in later that is much more accurate. Yeah. You pair those two things together, and it's kind of hard to not see that continuing to happen.
Yeah, and the Federal Reserve has even done its calculations and said that it's a little bit weaker than what the BLS is saying. I mean, Ron, you're nodding your head.
Yeah. I just think it fits into the larger narrative as well of just the actual consumer not feeling the same readings, I guess, as the government's been giving out on quite a few economic prints. So it started with inflation. They said inflation was at a certain rate. Some people felt that it was affecting them much more, and it's kind of continued into other economic prints.
Fair enough. All right, here we give it, I think 4 down, 13 to go. We might cut it off a little early and just cover the rest of them for next week's podcast. Sam, if you're cool with that.
Cool with me.
All right, so prediction number 5. At over $36 trillion and counting, the U.S. Treasury can ill afford to have long-term interest rates get too high. The debt service will simply be too much. As such, expect the Federal Reserve to announce it is going to stop shrinking its balance sheet at some point in the new year. It's only a question of timing. This should be enough to keep long-term rates from climbing significantly higher. Now, guys, the reason why I say this is because, quantitative tightening is essentially reducing the size of the balance sheet. When they reduce the size of the balance sheet, they sell their securities back to the open market, get the cash, and pretty much retire the cash, right?
Yep.
And so that's kind of what happens. So I would tell you that, when they were quantitative easing and buying up all the bonds, interest rates went down, and then they were down for a while. Despite the quantitative easing not really being there, but when they started reducing the size of their balance sheet, that's when you started to see interest rates go back up. But then they kind of hit the wall when the Fed said, a couple quarters ago, was going to reduce the speed of the quantitative tightening. I think once we get the 10-year up to around 5% next year, the Fed is going to shed whatever semblance of independence it has, and it's going to say it's going to quit quantitative tightening just in general in order to put sort of a backstop on the bond market. I mean, Sam, you and I have talked about this, and I'm feeling you might not be as on board with this one.
I think it could happen, but I think even if they are fully independent, it would make sense for them to want to do something like that. So that, and I think the other interesting part is, what are they going to do with the mortgage securities on their balance sheet? I mean, that's not always been the case that they're actively purchasing mortgage securities. We've seen the spread between treasuries and mortgages widen out pretty significantly. So is that something that they put their foot on the gas more? That's been, I think, a longer term goal to get away from that. But the way things have gone, it's kind of going the opposite way.
Well, I don't know how to respond to that, but that's a good answer. So, Ron, what do you think?
Yeah. I mean, just on the consumer side, I'm sure around the Christmas table this year, you've gotten some questions about mortgage rates and such, or
I don't know what kind of dorks you think my family. No one asked me about any of that. No one asked me. No one asked me about any of that
swap
stuff.
Spreads.
But I've gotten.
They're trying to flatten out the J curve. We're not talking about that stuff, Ron. Come on.
No, I've gotten plenty of questions saying, "Well, the Fed is cutting rates. Why my mortgage rates? I'm trying to lock something in. Why is it not, getting lower at all?" But I mean, we talking.
I think the only person asking that question might be Emma.
All right, you got me there, John. But just talking about some of the longer term rates just staying elevated, and consumers don't always seem to quite understand how the 10 years kind of related to mortgage rates. So interesting to see kind of from the consumer side that people still are waiting for some of those longer term rates to make a move downward.
Well, you're right, and you're right about that on 10-year rates. It has a much better correlation with long-term inflation expectations than it does with whatever the Fed's doing at any given rate in time. Now, intuitively, if you think about such things, when the Fed cuts the overnight lending target, that should be inflationary because it should induce borrowing and lending, which should increase the money supply. So when the Fed is cutting shorter term rates historically, and I'm supposed to say historical performance is not indicative of future results, but historically, when the Fed cuts the overnight rate, longer term rates will typically creep back up a little bit as inflation expectations rise throughout the financial markets. Fair enough?
Spot on.
Yep. All right, love it. All right, prediction number 6. At the end of 2024, the Fed had telegraphed 2 more 25 basis point rate cuts in 2025. By the middle of the year, the Fed will have the data it needs to make additional cuts should it choose to do so. Now, that's a little bit more my prediction than maybe the remainder of the investment committee. However, we're going to throw it in there. And I'll tell you the reason why I feel this way. I don't think Sam is completely on board with this. I think he's mostly on board. He can get around the argument. Ryan's probably the same way. I'm a lot older and meaner than these two guys are, so sometimes, it is what it is. And I tell you the reason why I say that is because, as I mentioned about the labor markets earlier, and the BLS having to revise some of that data, if you peel back the layers of the onion of a lot of labor market reports, yeah, the labor market's still pretty good. All things considered, for where we should be in this economic cycle, I would say the labor market's pretty okay, truthfully. However, it's not I don't believe it's creating the 200,000 plus jobs that we routinely get. I also find it very curious that the labor force participation rate, is continuing to shrink. The household data is a lot weaker than really anyone would like. So when I take a look at all of that type stuff, I'm thinking, okay, labor markets are going to show some obvious signs of weakness next year. Not being completely weak, fall off the table sort of weak, but weaker. Now that's important because the Fed has a dual mandate, right? Price stability and full employment. And so if the labor market's showing signs of weakness, that could trickle over into inflation, because when we're creating jobs, we're creating consumers, and we're creating paychecks, and we're creating consumers. If we aren't creating the jobs, we're not creating the paychecks, we're not creating the consumers. Go back to your supply-demand curve graphs. Demand should be relatively tepid to start the year as companies don't hire as much, and that should keep prices relatively in check. And as a result, I think the data is going to be a little bit weaker, and the Fed will be able to do whatever the hell it wants.
Well, and we've also seen from their playbook recently, when they cut 50 points instead of 25, they are willing to respond to weakness in the labor market. So whether that weakness comes from, hey, we've actually had more people in the labor market than we previously thought. That'll spike the unemployment rate without anyone losing their job.
Yes.
So however we get it, if we start to see that unemployment rate tick up, historically it doesn't just tick up a little and then stop. So I think the Fed, we've seen that they're willing to respond to that pretty rapidly with that 50 point. I mean, people were calling for an intermeeting cut. And so whether we get a 50 point or what, I think the playbook is open. If we get weakness in the labor market, the Fed is going to respond to it. So whether we get more than 225s or less, I kind of feel like that's unlikely that we get 2. I feel like it's going to be one or the other, that we get close to 0 or that we get 3 to 4.
I would agree with you on that. I would tell you the over-under line for those of you betting on such things, and I would advise against you doing so. The over-under line would be 2, and I'd be taking the under. Ryan, your thoughts?
Yeah, I mean, this is just like, going into 2024, markets were expecting quite a few more rate cuts than we actually ended up getting. So, I would probably agree with you, John. I think that the Fed might kind of, they say they're data dependent, but they kind of might want to see kind of how the rate cuts kind of work their way through the financial system. So, I would agree with you, and especially coming off this past year where there was so much optimism around rate cuts and they didn't really come to fruition.
Well, I hear you on that. All right, so now we've gone through 6 of our 13 predictions for next year. Why don't we do one more here today, guys, and do the remaining 6 for next week, if y'all would like to do so?
Love it.
Yeah.
I think that makes sense. We'll do this one and then kind of maybe summate sort of what we predicted thus far today. All right, prediction number 7 for 2025. The Republicans will likely squander their opportunity to fully consolidate power by fighting amongst themselves. If they are smart, the Democrats will use the time in 2025 to recraft their message and elevate electable future leaders. So I think I've alienated everyone with that. You guys, your names are going to be on this, fellas. I'm sorry about that one. But when I take a look at everything that goes on out there and what's recently happened with the debt ceiling, all that type of stuff, I will tell you this. I think the Democrats are a more unified political party. And so it's kind of what the party boss says, and they get it done. I don't think the Republicans are anywhere near as unified like that. I don't think within the party they have the same sort of party bosses. So we're going to see some of the alt-right sort of type people really struggle with some of the more moderates in the Republican Party to get through a lot of type stuff. I could see it really being kind of a fractured year, as Donald Trump thinks he's going to come in and do all this, that, and the other thing. You still have a lot of Rockefeller-type Republicans, in the mix. And, of course, the Democrats are going to vote against everything. I don't think it's going to be as smooth as what a lot of people in red states are hoping it will be.
Well, and we've seen this recently.
Yeah.
We've seen the fact that the Speaker of the House, when it's a Republican, we saw it with Kevin McCarthy.
Yeah.
We've seen it with Mike Johnson already being at risk of losing the Speaker. And we've seen Democrats opportunistically side with certain Republicans to cause more volatility. And so I think that's easily something that's going to continue in the fact that, people are talking about this being a mandate, the election being a mandate. And maybe the presidential was. I'm not going to get into that. But the House was clearly not. We did not see strong red wave. We saw them barely eke out.
But they pick up one seat or no seats?
Yeah, and so the fact that the Freedom Caucus in the House is going to play such a pivotal role, and frankly, there may be some issues that they start siding with some Democrats, or the Democrats side with them, just to continue this track of volatility with the Republican Party.
I mean, Ryan, you tell me. You have to understand, everyone out there, Sam grew up in Texas and later on Georgia, now lives in Alabama. Yeah, pretty red states for the most part. Outside of Atlanta, Georgia is, without a doubt. Ryan, you moved to Alabama from Burbank, California.
Yep.
So you've seen about as far left as you can get in terms of local politics to about as far right as you can go. What do you think about this particular prediction?
Well, I'll just say in general, living in those two places, it just made me realize how, not only moderate I am for the most part, but also most people, John, are somewhere right in the middle. We have this narrative that, crazy Californians, super left-leaning, crazy Alabamians here, super right-leaning, but realistically, most everyone's somewhere smack dab in the middle. And, just kind of talking to people, younger people, kind of, voting either for the first time or maybe second time now. But really, I just see that there's so many sub-factions, it seems like, in the Republican Party. You know, the pro-Trump side, the anti-Trump side, the they have the term rhinos and things like that. So it just, you're right, it does seem more fragmented as a party compared to the Democrats, but even the Democrats, being as unified as they are, can't seem to elevate someone that, as you put it, electable future leader. So I would agree.
All right. So that had to be a little bit of a culture shock for Ryan, coming from California to Tuscaloosa, Alabama originally, and now living in Birmingham. I'm glad you got out.
Me too, John.
Yeah, so apparently a lot of other people are. So there you have it, our first 7 predictions, not necessarily in any order. We've got another 6 that we'll cover next week. But all told, if you're kind of wrap it all up and kind of combine them all, it might come across as sort of a cold glass of water. Some folks who think that, hey, we're going to enter 2025 full wind in our sails, all that type of stuff. And this is just kind of a pragmatic, probable case scenario. We've had a couple great years in the stock market. Economic activity has been better than they should be, at least according to the official data. Take a look at just everything out there, and it should be, maybe a little bit of retrenchment first part of the year. Back half of the year probably should be a little bit better, but probably more on that for next week. Sam, what are you thinking?
I completely agree. This year, all said and done, was a pretty good year.
Yeah.
Yeah.
Ryan?
Yeah, Sam said it best. The Bulls make money and the Bears, they're
Sounds
wrong.
smart.
yeah, sounds smart. Yeah, so
It's a lot of truth
keeping
to
some
that.
optimism going into 25.
Yeah. All right. Well, guys, thank you all so much for listening. If you have any comments or questions, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more or hearing more of what we got to say or how we think, you can go to our website, oakworth.com, oakworth.com. Take a look underneath the Thought Leadership tab and find links to all kinds of exciting information, including previous Trading Perspectives podcasts, as well as links to our newsletter/blog. I'm so old that it used to be called a newsletter. Now it's called a blog. That's Common Sense, as well as our quarterly analysis, all the individual components, stuff by some of our client advisors, John Hensley, Janet Ball, Richard Littrell, as well as stuff from our advisory services group, which is headed up by Mac Frazier. All right. Sam, anything else on this exciting topic today?
That's all I've got.
Ryan?
Thank you for having me, John.
It was our pleasure. That's all I've got today, too. Y'all take care.